Welcome back. Time now for top picks from Zachary before we say goodbye. And as promised, Tourmaline Oil, a big natural gas producer, is one of your top picks. Zach?
Yeah, again, we've talked a fair bit about oil on the show today, but not a whole lot about natural gas. And again, the price of natural gas, while off the highs, certainly at the levels that we're seeing now, bodes well for all of the natural gas producers. And you read about what's going on in Europe and in Russia and Ukraine, and you look at where natural gas is, and potentially this upcoming winter could see prices higher. And again, even at these levels, the cash flows for natural gas producers are high. Tourmaline pays a dividend and shares yield about 1.5% ballpark. But they also have announced special dividends, and if you factor those into the component, the yield gets you closer to 5%. And it really comes down to a best-in-class management team that has built and sold two businesses before. They own a significant portion of the equity. They run the business like owners, and again, returning money to shareholders is a common theme in the energy space these days. So high prices with good cash flows and a superb team with special dividends, that is a very rewarding prospect in our view going forward. So pretty positive on the outlook for Tourmaline, and think it's one of the best managed oil companies, natural gas companies in Canada, for sure.
Top pick number 2, American Tower AMT on the New York Stock Exchange.
Yeah, this is really interesting. I would say timely that American Tower owns and operates wireless and broadcast towers, and the stock trades at a pretty hefty multiple. It's not a cheap stock. Pays a little over 2% dividend, but again, it's based on the premise that wireless use will go up. Continued rollouts of 5G in the U.S. and Europe. And around the world where American Tower has their services will continue to grow, and people will continue to use more and more data, and the revenue will go up. You had Brookfield yesterday with a deal to buy some German and Austrian towers from Deutsche Telekom, and the multiple was higher than where American Tower trades. So I think that's a positive. And again, a smart buyer in Brookfield. So, positive on AMT, and the fact that usage will continue to grow. There's inflation protection in there, so positive on increasing inflation. Just a good defensive name there in our view, but not cheap.
Number 3 is in the pharma sector, the international pharma sector, Merck & ticker symbol MRK in New York.
Yeah, again, Merck made an acquisition last year, Acceleron. They have a very broad product offering. Acceleron was in the cardiovascular space. They had some potential COVID, I think more than, expected, but there's also a rumor that they're looking to acquire Seagen, which is a cancer drug company. That's Merck's biggest product, Keytruda. And again, it's a pretty defensive space and name, the pharmaceutical side, as drug prices tend to be pretty inelastic. So in times of uncertainty, you might give up some things, but not your pills and medications. So there's good pricing power there, good dividend yield, cash flows there. Again, commenting on the rumor about Seagen, but they have been an acquirer before. They have a broad scope of products, and defensive, which I don't think is the wrong place to be here. Given that that's a component of your portfolio, this would be our name, one of our names in the healthcare space for sure.
What's your advice to investors on how to assess different pharma companies? I think one concept that most viewers are familiar with is the idea of a patent cliff and whether or not companies' key products have long-lived patents ahead of them. What are some other factors that you use to assess one pharma company from another?
Patents certainly is there, and again, that's one of the reasons for Merck, I think, with the possibility of Seagen. But another is the rate of price increases. In our view, if a company has increased prices significantly, one, that means they can't do it in the future going forward just because there tends to be a fair bit of pushback. But two, that doesn't leave a lot of room for future potential there. So I think the slow and steady approach to price increases is the right way to go. The companies that have increased prices dramatically are the ones that tend to, get into hot water. But a broad product offering really is one of the other keys. How many drugs they have in, I would say phase 2 or phase 3 trials. I think phase 1 trials are pretty opportunistic, but phase 2 trials, phase 3 trials, that's something to look at too. There's lots of products always under development. It's just really which ones can clear those hurdles and move forward. But certainly it's a good defensive characteristic, pricing and broad scope of products in a time of uncertainty like now. To be able to have that stability, if you will, of cash flows coming in from people who won't give those products up.